Hey guys, and welcome back to my charts. Like you know, I just love to use my charts to basically help you understand what exactly it is I'm trying to say a lot better. Now, it's one thing for me to just stand on my whiteboard and just be like, oh, if the market does this, do this. You know, it's a different thing for me to come on my charts here and actually explain to you guys and show you guys what exactly it is I'm speaking about. Now, today we're going to be talking about chart patterns, chart patterns, and I'm going to be showing you how you can use this to profit from reversals in the market, how you can actually use, or rather how you should be using chart patterns in your trading. Now, I see a lot of people using chart patterns on time frames that I don't exactly encourage, such as the 1 hour, the 30 minutes, the 4 hour, some even the 15 minutes. You might see a head and shoulder on a 1 hour time frame and you think it's going to hold. Usually, chart patterns on lower time frames do not really hold that much water, because you have to understand that, you know, it's just a pattern that formed during the course of the trading day. All it takes is for one very strong news event to come in, you know, from probably the central bank of the ECB, or probably have the Federal Reserve coming with some kind of news, or you have Donald Trump say something, and then before you know what's happening, you just see candles, you know, absolutely destroying your chart patterns that you are preciously saving for that very juicy trade. So what I'm trying to say in essence is chart patterns on lower time frames do not exactly hold, as well as chart patterns on higher time frames. So that's why I decided to over the years, trust me guys, I've been trading this market for 8 years, so I've been burned so many times. So I trust me when I say I know what works and what doesn't work. Now, what works is to actually find chart patterns on higher time frames. Now, first things first, I want to establish a very crucial point. The foreign exchange market, the professionals who trade the foreign exchange market, break down the foreign exchange market into two bits. There's the analysis and there's the trade execution. Okay, so we use chart patterns for our analysis. We do not use chart patterns for our execution. You keep hearing me saying chart patterns. Chart patterns are simply double bottoms, double tops, head and shoulders, and inverse head and shoulders, that kind of stuff. I've seen so many people trying to enter the market, like I say, trade execution, trying to enter the market with double tops, double bottoms, inverse head and shoulders, and head and shoulders. You know, you try and execute your trade based off of these chart patterns, and you find out that it doesn't exactly work that well. As opposed to when you enter the market, as opposed to when you use these chart patterns to analyze the market, once it's giving you a bias, once it's giving you a direction, then you can now use different strategies to enter the market. I'll take that again. Chart patterns are used for analysis, not for trade execution. Sorry guys, I had to flip off the light switch because it was kind of like affecting my reflection. Yeah, so back to what I was saying. So today we're going to be using chart patterns and basically understanding them a lot more and how we can use them in our trading. Now, the first example that I have in front of me right about here is the GBP/USD. Now, this was a reversal that happened around 2017. I know this is a lot. You know, this is months after 2017, but the reason why I want to use this to explain to you guys is because I was trading the market as at the time this happened, and I made so much profit off of this particular trade that, you know, it was absolutely, you know, mind-blowing, and a lot of people didn't understand how I called the on the cable, and I want to show you guys how exactly I did this. Now, for those of you who watch some of my other videos, for those of you who watch my weekly breakdown every single week, you realize that I say I come on the monthly to find candlestick patterns, I come on the weekly to find chart patterns. So what I'm trying to say here in essence is that I only look between the monthly and the weekly for chart patterns. Okay, so I don't come on daily. Obviously on the daily, it will be there on the daily, probably look a little bit more bigger, but I usually come on the weekly for chart patterns. So as you can see, this market was falling all the way from the upside. This was the Brexit spike right about here. So we had the Brexit spike all the way to the downside, and the market was very, very much bearish. Now, this market pulled back like so to the upside. After we pulled back, this was on the weekly time frame, I caught the reversal to the upside using some lower time frame strategies, caught the reversal to the upside, and I knew it was time to start selling again, so I hopped on short. and of course we had support all the way down here, somewhere about here. Actually, I took out my profit. I always like to come and take out my profit at the body of the candle. Now don't get me wrong, I wasn't trading this on the weekly time frame, but I'm keeping it on the weekly time frame so that I can, you know, explain this. Obviously I came to lower time frames and a 4-hour daily to catch massive amounts of pips, okay? But you know, lower time frames are still a representation of what happens on higher time frames, or rather higher time frames are still a representation of what happens on lower time frames. So you know, I saw the move to the downside, and then we had a double bottom, right? And then I started to see the market move all the way back to the upside. And then I realized that we failed to come and make even equal highs. We had made double bottoms, but they failed to make equal highs. And, you know, at this point, it was just looking like a range to me, and I thought the market was going to roll over back to the downside, and we could continue selling. But what happened was the market collapsed all the way back to the downside. Get me, right? At this point, the market rallied all the way back to the upside. I wasn't trading anymore. I didn't have any trade setups because this was looking like a double bottom facing the upside. I didn't have any trade setups. Don't forget the overall trend was bearish. So at this point, I actually was not trading actively. And then we dipped to the downside again. I still didn't have any trades. But when we dipped to the downside, I realized something very interesting. Okay guys, I noticed that we had a left shoulder, and I noticed that we formed something that looked really like a right shoulder, and I'd seen this guy pop out here looking like a head. So what I was seeing right in front of me on the weekly time frame was actually an inverse head and shoulder. Now the way I go about trading head and shoulders is this, right? Now, for those of you who don't understand how head and shoulders works, you're supposed to wait for the head and shoulder to complete its pattern within a range. Okay, from a left shoulder, from a head, from a right shoulder. Now, your duty as a trader is to wait for that head and shoulder to break to the upside. Once it's broken to the upside, according to most of the scholars out there, according to most of the blogs and the books that teach you, even on the book that we share on our academy, we encourage traders to go ahead and, sorry, my screen just absolutely wiped away. Let's wait for it to load up a little bit. Just give it some time. Perfect. So we're back. Okay, so most of the books encourage traders to basically trade the breakout of a head and shoulder. Now this is an inverse head and shoulder. The breakout usually is about here, this region. So the book, most of the scholars and most of the books encourage people to buy at the break, or rather sell, depending on which way this head and shoulder was facing. So this is an inverse head and shoulder. This is looking like a bullish head and inverse head and shoulder. So basically this pattern is telling us that once we break this neckline, this is the neckline, okay, basically we're supposed to be buying, right? So everybody's usually getting in at the long position around this time and stuff like that. But the way I trade the market, I don't buy chart patterns. I don't buy at the signal of a chart pattern. I don't buy at the break of a neckline. This is what I do, and this has actually helped me maximize, you know, my profit potential so much. What I usually like to do is this. I use chart patterns. Basically, I tell you, okay, it tells me, okay, I've formed an inverse head and shoulder as it's done so far. I know that once we break out of that neckline, we're going to be bullish. And usually, we are usually bullish. Okay, so there's something called, there's something we traders do is we calculate the range. Okay, we calculate the range of pips that was formed during this consolidation. So let's say between them, and we calculate it from the head of the, we calculated it from the head of the head and shoulder to the neckline, right? So we calculate from the neckline all the way to the head, right? And then we add that pip count to here, to the neckline. And what this helps us do as traders is to basically predict where this head and shoulder is going to run into. So basically, there's this philosophy that states that, you know, the amount of pips that was collated during the consolidation phase, once the market breaks out of it, it is going to basically expand into those same amount of pips. So let's say we consolidated and the consolidation range was 500 pips. So basically, once we break out, we'll break out for another 500 pips. So that's the methodology behind it. Okay, so You know, I use this a lot in my analysis. So basically I came to put this green line here, and I said, okay, once we break out of here, instead of buying right at the breakout, although I know it's going to come here, but instead of buying at the breakout, I think I would rather, because I already know that the market is going to move from point A to point B anyways. So instead of buying here and my stop losses have to come all the way down here or here, all I simply do is I wait for a breakout. I allow the analysis flow. I allow it show, go. You know, I allow it go like a river, go. And then I allow the market pull back. Now it is when the market has pulled back that I will now grab my Fibonacci on a daily time frame. I can't go onto a daily time frame at the moment because once I go on a daily time frame, it's going to take us all the way to current price, and I don't really have the energy to start going, you know, back and forth and all that. So I would usually come on a daily time frame and I would draw my Fibonacci from the immediate swing low to the immediate swing high, and you would realize that Fibonacci would line up alongside the neckline. Now it is at this point, at the bounce off of Fibonacci, from you guys must have realized that I tend to use Fibonacci a lot in my trading. I tend to use Fibonacci a lot in my analysis. Now you would realize, just give me a moment, let me just adjust this properly. Okay, now it is at the bounce of this market from this support, which is the neckline, and the Fibonacci to the upside that I will be looking to buy. So you see how I've used the head and shoulder as my analysis is giving me a direction. So basically I use chart patterns to confirm my bias, confirm my direction, break out of the neckline so that I can come to a smaller time frame to execute the bigger picture. So you can see how we've come into this Fibonacci zone, we've bounced out of it, and as we're about to head higher, that's exactly where I'm going to be buying. So I actually did trade this market, so I bought here. And instead of my stop losses coming all the way down here, now let me expand this properly. Excuse me, my computer is a bit slow. My charts are moving quite slow at the moment. I have no idea now why. So I'll just put this here. Keeps refreshing. That's fine. Just give it a little bit. Just give it some seconds, guys. Perfect. We're back. Okay, so it is at the breakout, not the breakout, at the bounce of this. I hate this tool. Get out of here, man. I'm gonna delete this. Yeah, correct. So now, guys, it is at the break of, it's rather at the bounce of this Fibonacci level, right about here. Okay, if it came on the daily time frame, this is a weekly bullish engulfing. So on the daily time frame, it probably took us about 7 days to move from 5 days for us to move from here to here. So trust me, there was a lot of buying opportunity. So ideally, if I bought here, my stop losses would have either come here or here. But because I'm buying here, based off of a bounce of the Fibonacci, my stop losses now come only down here. Okay, and in terms of where to take my money out, because I know that inverse head and shoulders, or head and shoulders in general, usually play out the same amount of pips that was consolidated within the range. It plays out those same amount of pips once we break out of the neckline. So I know that basically what I'm trying to say here is that I buy here, take profit is all the way at the green zone. Let me delete this. I buy here, stop losses here, take profit here. So you can see how I used my inverse head and shoulder as the analysis, and as the market has blown out, the market blew out of the range, pulled back into the neckline, and as we started to climb higher, that's exactly where I wanted to start getting long. And as you can see, the market pushed higher, made higher highs, pulled back into Fibonacci. I can bet you for free that this is the Fibonacci level. If I draw it from here to here, A, B, this is Fibonacci. So I have one trade, I have two trades, and you can see how the market just coasted all the way to this green zone about here. And believe you me, guys, this inverse head and shoulder, okay, I'm gonna delete some stuff right about here. This is gonna be quite a lengthy video, but you guys are gonna benefit a lot from this video, okay? Put put the lights back on so that you guys can see my face a lot more clearly. Cool. Now you can see how this market was absolutely bearish all the way from the top all the way to the bottom. Let me zoom this in so that you guys can see properly. All the way to the downside. Now this inverse head and shoulder is pretty much what is responsible, right, for the reversal on this chart. So you can see how this guy was responsible for the reversal, and then we started to make higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then the market came in and put in equal highs. Now you would realize that after this market put in equal highs, another chart pattern was formed. Now this chart pattern is known as a double top. This chart pattern is known as a what? Double top. Now the same thing happened. I realized that this was a double top that was forming. Guys, you can see, I noticed that the double top was forming. What did I do? I didn't sell. I did not sell. I did not sell at the breakout of this double top. I didn't sell at the breakout of this neckline. I waited for this market to collapse basically allow it, so it has its own characteristics. It states that if I break out, basically if a double top breaks out, if it breaks out from the neckline below, if this double top breaks out below, this double top you can see, if we break down below, okay, so this is a double top. When we have a double top, it usually means reversal to the downside. So we break out of this range, okay, and the characteristics of a double top is that once we break out of that neckline, it is usually a trend reversal. It is usually going to play out the same amount of pips that you used to consolidate in the box and all of that stuff. So I already know the characteristics of this chart pattern. All I'm doing is I'm allowing the characteristics play out, but I'm taking advantage of that characteristic on a smaller time frame. Same thing for here. I did not short this market at the breakout and then come and put my stop losses above. No, I did not do that. I simply waited for this market to break all the way down here. I waited for a pullback. As you can see, I'm sorry I'm doing this on a weekly time frame. If it was on daily time frame, you literally see this is a lot more. This is almost 2 weeks of consolidation. Definitely on a daily, on a 4 hour. I'm probably going to make a video on this, on how to trade consolidations. So basically you can see the market consolidates for 1 week, 2 weeks. Simple. Coming here with my entry strategies. Now I have my entry strategies for this market. I come in here. Once the market has done this, now I can scroll to a lower time frame. I've done my analysis on a higher time frame. It showed me that I want to go south. Now when I come on a lower time frame, I simply look for what? Selling opportunities. And guys, you have to understand that these chart patterns are so important. If you realize, you see that this market collapsed all the way to the downside. What caused this market to reverse upwards was because of this inverse head and shoulder, right? So we reversed to the upside. When the market was tired of reversing to the upside, what did it do next? It came in and put in a double top that now caused this market to start falling all the way to the downside. So what I'm trying to say here in essence is that if the market ever wants to change its direction, it will show you a chart pattern on a weekly time frame, okay? And as you can see at the moment, on a very big scale, GBP USD has come in to put in a massive double bottom. Massive, very massive double bottom. And as you can see, as we put in this second touch of the support, meaning a double bottom, the market is now pushing all the way to the upside. So guys, chart patterns are actually used on higher time frames to basically give us a direction. That's number one. Number two, chart patterns I think this should actually be number one. Chart patterns are actually used to change the direction of the market. So if the market was ever trending in a particular direction, as you can see, this market was trending downwards. It wanted to start going upwards. What did it do first? It gave us a chart pattern. It was trending upwards. It was tired of going upwards. What did it do? Give us a chart pattern that sent us downwards. Now, this market was coming down. It's tired of coming down. What has it done? It's giving us a massive double bottom and it's pointing to the upside. So these are the clues that the market always gives us, right? These are the clues that the market always gives us to tell us that, hey, I am tired of this particular direction. I want to turn around. The market doesn't just turn around. It gives you a certain number of clues. It gives you heads up for days and days before it finally changes its trend. So let me see, do I have any more examples? I think I have one more example on gold, you would see me talking about gold a lot. I have one more example on gold. This time around, it's best you come on the monthly time frame because that'll be the best place to see it. Now, if you come on the monthly time frame for gold, right? Just expand this. If you come on the monthly time frame for gold, you'll notice that we have this massive uptrend making higher highs, higher lows, higher highs, higher lows, higher highs and higher lows, right? So what higher highs and higher lows simply mean is that this market is basically in an uptrend. The characteristic of an uptrend is the market will start making higher highs, higher lows, higher highs, higher lows, right? Let me just draw this out for you guys because it sounds like I'm talking gibberish. Higher high, so that's a high, this is a low, and now we push all the way to the upside. This is higher than here, so that's a higher high, isn't it? And we pull back into this low. This low is higher than this, so it's a higher low, isn't it? So the characteristic of an uptrend is the fact that we consecutively make higher highs and higher lows, higher highs and higher lows. So if I know this market has made a higher high, made a higher low, made a higher high, made a higher low, that means we are indefinitely and definitely, that doesn't make any sense, but you know what I mean, going to come in and put in a higher high somewhere around here. So already I know that gold is bullish just by looking at the monthly time frame. Gold is going to come in and put in a higher high. So I can go anywhere and tell them I think gold is going to make record highs because previously we've been making higher highs and higher low in a very strong uptrend, and we have made a higher low, which is here, and we have blown out of the higher low, and we're coming to make a higher high at about $2,100 per ounce. Okay, so that's my first analysis on gold. Now that I've been able to identify that gold is obviously making a higher high and higher low trend and all that jazz, you're probably asking yourself, what does this have to do with chart patterns? Now I'll show you how chart pattern has actually confirmed my bias of a higher high and a higher low type of scenario. Now guys, another thing that I also realized about this is if I draw my Fibonacci from swing low to swing high, okay, so this is a swing low, this is a swing high, and this is a Fibonacci region right about here, as you can see. Okay, so from swing low all the way to what? Swing high. We've pulled back into 50 fib and then we're pushing out of it. So apart from the higher high and higher low sequence that has formed, Fibonacci is also telling us, yep, you know, I've given you a base, you can now move higher. So that's strike 2. Now strike 3, don't forget that this market was in a temporary downtrend, right? And the actual reason, apart from the higher high and higher low and the Fibonacci that occurred, the actual reason why this market reversed to the upside is actually something called an inverse head and shoulder. You might not see it properly until I draw it, about so. So that's the left shoulder. This is a right shoulder right about here, and this is the head of this inverse head and shoulder right about here. So this market has pretty much come in to put in an inverse head and shoulder, as you can see, just about here, and this is exactly where the neckline is, right about here. Okay, as you can see, we have broken the neckline, and we all know, guys, once we break out of the neckline and we have a bullish close above the neckline, what happens next? The market is actually going to move in that direction. So this is the W, right? The W that has formed, and once we break out to the upside, we're usually going to come and push all the way up here. So, you know, you can see how I've used chart patterns to basically give me a very clear direction of where the market is going to go to, and we all know how these things go. We can now come to a lower time frame. Actually, for gold, I'm going to come to a lower time frame and actually explain to you. We can come on a daily time frame. Now you can come on a lower time frame, like a daily time frame, and basically anticipate a pullback. Basically, you want to come and anticipate a pullback. You can draw your Fibonacci from, pardon me, let me zoom this in properly. You have to understand that I'm doing this on a real chart, so it gets a bit fuzzy sometimes. So now that so now guys, this is the neckline I was speaking about for the bigger picture. So we can potentially pull back into it. We might not necessarily pull back into it. We can actually blast off from here. This market has been holding here for quite some time. Either way, gold is bullish. So now all I need to do is basically come in here with one of my lower time frame strategies, come in and put my lower time frame strategies, and then, you know, look for potential buy. So at this case, what I'm trying to say is I'm only going to be looking for buy scenarios. Okay, so you can see how you use chart patterns to basically give yourself a direction. If the market ever wants to change in trend, I'm going to recap again. If the market wants to change its trend, it will always show you a chart pattern. Sometimes it comes, most of the time it will come in form of a double top or a double bottom. Sometimes it comes in form of an inverse head and shoulder, or indeed a head and shoulder. Feel free to watch the beginning of this video if you didn't quite understand what these different chart patterns look like. I'll be sure to obviously explain. Obviously it was already explained in the beginning of this video, so you have no worries whatsoever. Yeah, Grant Cardone just released the video. My favorite guy, absolutely. So guys, if you haven't already hit the subscribe button, be sure to do so. Hit the like button. If you felt this video was helpful and you want me to confirm or clarify anything, you know, a bit more, kindly comment below and tell me what you think I should talk about next in my next video. Alright guys, so I'm going to take you all the way back to the whiteboard, and I'll catch you guys in my very next video. Ensure to subscribe and hit the like button and comment. Very important. I actually should start doing some giveaways soon. Alright guys, so I'll catch you guys in the very next video. Stay tuned to the whiteboard. I have some little nuggets I want to drop before I round up the video. Alright guys, bye and cheers. This one.